The financial crisis of 2008 never stopped. You can see this today as it goes around the world. It continues, and in fact, it has been exacerbated by all of the policies, and simply, they're just not getting it. The global economy is crashing, and the Fed simply can't stop it. Let's go into the news right away. I wanted to cover this. First, an infographic. This is pretty interesting to look at how much $1 used to get to. So you can go through it all for yourself. I'll just point out a couple that are quite interesting here. You can see that at the bottom here, about 100 years ago, you can get 10 cans of Campbell's soup, and right now, you can't even get 1 can for that same amount today. And there are other ones here, showing you the beef prices. And look at this one from 1941. You can get 4 movie tickets, a whole family worth with that $1. Now you can't even get a quarter of a movie theater water bottle. It goes to show you what has happened to the dollar. And I did a similar diagram in my book here, just basically showing you what $100 was worth. And these are approximates. Of course, in 1900 gets you a car, in 1950 gets you a motorcycle, and in the year 2000 it gets you nothing but a bus pass. That's the dollars printed on that bill, and they're basically nothing but a whole fallacy, essentially. This is right here what has happened. These policies of the Federal Reserve and the governments around the world are affecting the poorest people the most, and next the middle class. So this is the leverage ratio of the poorest families, and you can see how they are getting in big trouble right now. And this is pretty obvious. You can see how dramatic it has been, and it's just gone in practically a straight line since the year 2000. It's gone up from there. But have no fear, because you can still get your iPhone 6 for $0. That's right. Wherever there is trouble, there's always someone to take advantage of that. And here they are. This is Sprint saying that, you know what, you don't have any money. Don't worry about it. We'll take care of it. You can just pay us later. And you know how this works. People are cash strapped. They are indebted. And this is, I've seen Canada, the US, and everywhere around the world pretty much, where the individual citizens are not saving any money. They're all the way up to their neck in debt, and it simply doesn't matter, because there's always going to be new schemes that they develop, and this simply can be seen in every single category. But I talked about this in a previous video, talking about how the central banks around the world are purchasing stocks. Now here's one in particular: Israel to begin investing reserves in US equities. Now this was back in 2012, however it's still continuing today. And this is out of Bloomberg, and one of those that they are investing in is quite interesting. It's at the very bottom of the screen, Apple. And you can see the Apple stock has boomed over the last few years, and one of those reasons is you have central banks buying up the shares. That's right. So these central banks print money out of thin air, and then they boost up the equities markets. That's how these equities markets are allowed to be like this, because you have policies, first of all, where you have low interest rates, the banks are borrowing at 0% essentially. It's free money. Then you have other instances where basically there's not a lot of safe investments out there that people are finding. So they're tending to pour their money into equities in order to make their money back, and in order to combat inflation. And then you have this, where you have the central banks actually getting incentives, as I brought, in that previous video I did. I hope you watched it, where I actually showed you the incentives that these central banks get in order to purchase these stocks. So it's pretty interesting how exactly the market is making its way up this high. Now this is the IMF's revisions of China growth, and you could see that as it going down, and the US actually was significantly down for their growth estimates. And of course, take a look at this in here in China, and basically what I'm trying to show you is that it's down. Now yes, it is still up. China is still growing at a rate that is many multiples of what it is in the US. However, the fact remains is that it's going down. It's slowing down. Why? Because the public works projects are not doing what they used to, and also they are an exporting country primarily, although many are moving into the cities and purchasing on their own goods. However, the primary situation here is that they are an exporting country, but other countries, particularly in Europe, are really having trouble right now. So of course they're not going to be able to buy as many goods as they used to, meaning that China's factories are slowing down, and then the whole economy drags down with it. So that's something important to know. This right here is a chart that I really like to show. I really want to know exactly how you refute this when you can see here the two previous bubbles, how they formed and how they popped, and then you look at what we have today and expect to see why this shouldn't be a problem right now. It is a huge problem because you have this bubble being pushed up partially by the central banks printing up the money and fueling this whole thing. Plus you have the central banks, of course, once again, they are feeding it with the low interest rates. And what do you think is going to happen if they do decide to increase the interest rates? You know what's going to happen, but ultimately they can continue to print money, and they could do that into oblivion, into a hyperinflationary scenario should they choose. I hope that you found this information very informative, and if you did, please give me a thumbs up. And also don't forget to become an insider. It's where I give out all my best intel for free, and it is available at themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.